Hello and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com, and that's Kaizen Kaizen. And while at my webpage, click on the podcast tab and check out our past shows and subscribe to our program on Apple Podcasts, Spotify, YouTube, and Amazon Music. Okay, when you set out to build, let's say, a financial strategy that attempts to help you reach your retirement goals, well, it can be easy to get caught up in the big, flashy things like income tools, enhanced planning, and where you want to live. And those are critical things that you should plan for. But as with so many other things in our lives, it's often the smaller and the overlooked things that make a big difference and a significant effect. So, let's say going back over your 401k allocations or changing your beneficiaries in a timely manner when the need arises, and even double checking your subscriptions are smaller things that, well, when combined, can turn out to be very impactful. Now, during the show today, we're going to highlight some of the lesser discussed but still critical planning steps. But before we jump into that topic, let me introduce my co-host, Tony Shore, who is all about the details, whether big or small. Hey, Tony, how we doing, buddy?
I don't know about that, Albert. I think you're the more detailed oriented one of the two. Trust me. I'm just the radio show co host. So I appreciate you having me on the show once again. I enjoy the show with you each week. And this sounds like a great topic. There are important financial steps people need to take to make sure they're on track with their investments, their savings for retirement, especially. And I know you're going to dig into some of that today. But yeah, I've had a great week. As I
Good.
mentioned to you before the show, I've been helping out my dad, getting him into assisted living, which is so much better. He's been alone on that farm, a huge farm,
Mm-hmm.
by himself, trying to do stuff for the last 3 years. And we've been so worried about him. But he finally agreed, and an opening came available at probably one of the best facilities in the state. So it
Nice.
was great, and we're really excited to get my dad into it's his own apartment. He's very happy.
Oh, very good.
So yeah. How about you? I know you've been really busy too, haven't you?
I have. Obviously we had the holiday weekend a couple of weekends ago, but just
Yep.
busy at the house and just getting things finalized finally. And after I think another couple more weeks, I think I'll be able to enjoy summer as it comes. So that's what I'm
Right. Well,
looking
you
forward
have
to.
so many projects at your house
I
going
do.
on. You're
I
trying to
do.
fix things up, and you've
Yep.
got a lot of work going on there. So, yeah, you didn't even get out much this weekend to do a lot besides work around the house,
Yeah,
right?
I didn't even get on the boat. I mean, wow, it was a beautiful
Yeah.
weekend, but
I know.
you got to get your chores done. So
Yeah, yeah, yeah.
just
You'll
like
feel good once, like you say, once that's done, you'll be able to relax a bit. That's nice. Now, for the show today, we're talking about financial steps that sometimes people miss, and it can be
yes.
costly, right?
Right, right. In fact, if we regards to a Clippinger or article, basically 10 easy, fixable, but often overlooked financial planning items offer up, I guess, some insights that we can touch on. And it
Sure.
first suggests that reviewing the Federal Deposit Insurance Corporation, for many of you guys, FDIC, coverage on your bank accounts. So don't forget that over time, your cash can really add up, particularly when you're still on the job and saving as much as you can for your retirement, which means that you should make sure that the money you have in your bank account, well, isn't greater than the FDIC limit, which is currently $250,000 for an individual account and $500,000 for a joint account. Now, a lot of you listening right now are probably picturing, the sticker, let's say that your bank has on the front door that says member FDIC. Well, many banks are members of this valuable program, which is basically insurance on your money if your bank were to fail. Now, but few people really consider these limits. Now, if you have a significant amount of money, even if temporarily from selling, let's say, a home or other assets, it may be a good move to spread that money across several bank accounts so that you remain below those $250,000 and $500,000 caps.
Wow. Okay. So that sounds really important. And I wouldn't want to mess around with any of this without working with a financial professional, a fiduciary like yourself anyway. But that is interesting that banks, a lot of people might not realize that banks do have a cap on what they insure. So if you have a lot saved for retirement, you don't want it all in the bank. You want to make sure you have no more than the limit there, and then other things other places, but it depends on your situation. And I know you help your clients allocate like that, right?
Yes, definitely. The main thing is always just keeping up to date and monitoring. In my opinion, in fact, this next tip, carefully reviewing your beneficiaries to make sure they're still
Ah,
reflective of your wishes. This is essential, Tony. I've seen in the past where people have failed on this, and the next thing you know it, they get a divorce, and they going through emotional trauma or times, and then they forget to make those changes, and then something happens down the road, and guess what? The ex spouse is still the beneficiary. So if that's not what you want, that's why we suggest you should be checking your beneficiary clauses. It's very, very big on this. Especially after if you made that election 20 or 30 years ago, you may want to make sure that everything is the same that your wishes are now. And checking that regularly when there's a big life event, or if you're just looking at your financials, maybe let's say every year or so, you may want to just double check on those beneficiary clauses.
oh, sure. That makes perfect sense. You don't want your beneficiary designations, and they take precedent even over what a will says, right?
Definitely, definitely. In
Yeah.
fact, it's the highest transfer of power of assets for that you have. Not even the Supreme Court can actually break that. So
Yeah. So if you got married and divorced right away and it didn't work out, then got remarried and were married for 20 years, had kids, happy, you want your 401k, your IRA, and all your accounts to go to your wife and your kids, your current wife and kids, but you'd never changed a beneficiary designation on that old 401k account. And now that's huge. And if you passed away, that would go to your ex-wife,
yeah.
right?
Oh, we've
Yeah.
seen it happen here
Yeah,
in
that's not
Michigan,
good.
and
Yeah.
that's
Or
it's tough.
ex-husband, I should say. Yeah, I
Correct.
mean, either
Yes.
way. I I don't wanna
Exactly.
be biased one way or the other. It happens both ways, and
Oh
I know
yeah.
you've seen it. Yeah.
I agree with you on that. But
Yeah.
now let's talk also on the next topic. It's just going over your 401k allocations, Tony. It's another big financial move that many people neglect. And I get it. You start setting up what you're putting in contribution. Sometimes you'll look at it because you want to maybe increase that contribution, but you don't really look at your allocations. You just figure, okay, people look at their balances and it's like it's going up and they figure they're fine. But really, we tell a lot of folks, you really want to look at the allocations of your 401k to make sure it's still in line with what you're trying to do. And if you let's say recently began working for a new employer and enrolled in, let's say, a new 401k and also have an older 401k that you haven't been closely monitoring, it's time to review those allocations to confirm that they still fit your overall financial strategy.
Yeah. Yeah, and that's the thing is making all this a part of an overall financial strategy and working with a financial professional such as yourself. And I think these are really, really important factors. And so you've got to review those accounts, right? Your 401ks, your IRAs,
Yes.
and make sure everything's there, right?
Definitely. And on top of that, you want to make sure that making essential provisions for the young people in your life is taken care of. If you have
Yeah.
children or let's say a child with special needs, well, you may want to discuss guardianships and trust with your financial service professionals or even an attorney. And doing so may be especially important if you're widowed or divorced. Often a child inheriting, let's say, significant assets, can cause strife, as when a legal guardian has control of those assets. So if your only heirs are currently still children, be sure to walk through your various options with your financial service professional.
Yeah, for sure. In fact, speaking of that, before we move on, let's let our listeners know how they can get a hold of you, Albert, to set up a consultation. I know you and your staff work so hard to help people, and you're offering a no charge, no obligation consultation if they have questions about these things. How can our listeners get a hold of you?
Yes, definitely. Listeners, you can visit my website at www.kaizen Financial Group. That's Kaizen, or call my office at 586-752-7008 and discuss how we can answer your questions and address your concerns about your financial strategy steps, your retirement ambitions, and other elements of your financial strategy.
All right. And today on Own Your Retirement, we're talking about financial steps that a lot of people out there may miss, and you want to make sure you don't miss these. What's the next one on the list?
Well, Kiplinger article, basically 10 easily fixable but often overlooked financial planning steps, next suggests that you should make sure you're maximizing the amount of earnings on your cash, especially in the last couple, I'd say, few years. Folks, we it was a while we've seen only like a 0 to 0.25% interest rates. Now in the last 2 years, holy cow, we're at interest rates that we haven't seen in 20 years, and you have to take advantage of it. Too many times I've heard people say, oh, I only see a couple bucks that I make every month in my savings account. Now, when you look at it, it's like $200 a month. That's a good feeling, but also knowing that you're putting your cash to work for you. And you got to make sure that cash is there, because I believe cash is king, but you got to make growth on it to stay ahead of inflation. Okay. And then the interest rates vary and change all the time. So that the next time you meet with your financial service professional, well, have the review, let's say even like bankrate.com, and see, if moving your money to a higher fixed rate is a financial strategy that should work for you guys. And then
Yeah.
relatedly, the article also recommends weighing your options if you currently have, let's say, an adjustable rate loan. Again, interest rates fluctuate and it's still unclear when they may be headed in the coming months. So if you have extra cash available right now, you can also think about using that cash to pay off those loans to protect yourself against the future rate hikes.
Yeah, those ARMs, or adjustable rate
Hmm.
mortgages and adjustable rate loans, they're difficult, especially during these times when interest rates are high. I try to avoid those myself, but for those who have that, you really got to get those paid down if you can. What's something else? I know there's a lot of different things with accounts that we need to be careful of. What's the next one?
Well, I would say your IRAs, if you're in the distribution mode, or let's say, the age where you have to take required minimum distributions,
Oh,
or
yeah.
even if you have inherited IRAs, because of the new rules that changed in 2020, with the Secure Act, people need to understand, that they have to make sure that they're taking those distributions. Otherwise, if they neglect you, they're going to be left with a pretty significant tax penalty. In fact, if you miss your required minimum distributions, it's now 25% penalty for the amount you were supposed to take. And remember, if you're changing, let's say, custodians or financial service professionals, take care to completely document whether you've taken any distributions for that tax year. Now, generally, those numbers are listed on your statement, but a new custodian or a financial service professional may not be aware of them. And, we just had that recently happen last year on us, Tony. We had someone that wanted to come aboard, and then we were putting things together, and she was in her early 80s. And we asked her, have you taken your required minimum distribution? And she told us no. But luckily, we have a process that we double check and everything. And when we looked, just to make sure, we had seen that she had taken it early that spring. So we were able to, save and protect her for not taking too much or more than she needed to, and then
Right.
causing her to have more taxes.
Hmm. Well, and taxes, that's another big part of all this, isn't it? I mean,
Oh, yes.
yeah, you've got to watch out. Some of these things we're talking about, these financial steps can have tax implications if you miss them or mess it up. So what's the next thing? What else do we need to watch out for?
Well, folks should often overlook strategies of adequately checking your health savings account, or
Oh,
HSAs,
oh yeah.
reimbursements, and the receipts. Remember, with an HSA, there aren't limitations about when your healthcare expenses were occurred and when they well, must be reimbursed. That means you may pay cash for medical expenses today and then request reimbursements for those same expenses many years down the road. By taking that approach, your HSA can continue growing with its tax advantage status. Now, since you aren't required to, let's say, request reimbursement immediately, it's important to keep all your relevant receipts and records now. And you also may want to consider using, let's say, a spreadsheet or an Excel sheet, one of many available apps that allow you to take photos of your receipts and track them down. That's the easy way to do it, folks. Remember, you all know how to make selfies. Just turn it around and take a picture of that receipt. It's that simple.
Yeah.
And then finally, be sure to regularly review, the list of eligible items, because a lot of people mistakenly assume some expenses aren't covered when they really are. For example, let's say long-term care premiums or feminine products, sanitizing wipes, and even sunblock are all eligible, Tony.
Yeah, that's crazy, isn't it? I mean, even
Hmm.
sunblock. HSAs, I believe, and you've said this before, I got this from you, Albert, is that it's really the only account, it's the only thing in the IRS tax code that allows you to put money into it tax-free, it grows tax-free, and comes out tax-free. So
Yes.
you get the tax benefit from the money you're putting in. You don't pay taxes on it. You don't pay taxes on the growth of the principal, and it comes out tax-free. And that's great. Now, it does have to be spent on medical expenses, but you don't lose it each year. It keeps growing, and you can keep it for, hey, load it full, pay out of pocket for medical expenses, or use what insurance you have, and let the HSA grow, and then use it for all the medical expenses you're going to have in retirement. Like
Correct.
you'll still have premiums, deductibles, co-pays, supplemental plans, advantage plans, things like that.
Hmm.
And hearing aids, things that Medicare doesn't cover.
Yeah.
So that's a great
And
idea. I'm glad we're talking about HSAs.
well, and,
That's
and
good.
what folks have to remember too is that, while you're working, that's the best way in time to pay, for those costs. And like you said, let that HSA keep growing tax free for the retirement period, because then you can also offset the Social Security taxes and all of that once you're retired, because you're using a program that is tax free for your
Mhm.
care. And that's big.
Yeah. Oh, that's huge.
Hmm.
That's huge. So, what next? What should we watch out for?
Well, recently, and this was interesting because I've had a lot of folks here in the past year calling us at the office saying, "Hey, we just got breached with our information,"
Mm,
or I've got a letter that says that we could have had some of our information, breached, and now we have this credit monitoring service. Look, you should frequently review your credit cards, your debit cards, and subscriptions just to be sure there aren't any fraudulent activity. Now, today's times, technology is great, but that also means people can use technology to do bad things as well. So what I would say is even set up, like, let's say, an alert on your phone that will give you a warning if there's suspicious activity happening. I know I myself have that on my credit cards and my bank accounts, and boy, every other year it seems I get an alert that says someone is trying to, use your identity. So it's very important to have those features in today's times, Tony.
yeah. Oh, for sure. I mean, obviously, you want to watch those things. We hear about companies being breached, and you got to watch the activity on your credit cards and look at your
Hmm.
statements closely. You've always said go through each statement, your bank statement and your credit card statements. Item by item, just sit there and go through them. It doesn't take long, and anything that looks fishy, you know, track it down, see what it was for.
Yes.
Let the credit card company know. Well, that's good. What's the next one on the list that you've seen people maybe make mistakes with when they're planning?
This is big. A lot of folks, as they get married and start a family or a career and all that, and they look into life insurance, they believe in protecting their families. But once the children are, let's say, adults and everything else, and it's just husband and wife again, they feel that that term insurance that then now is going to be expiring, they decide to drop it. Well, I'm going to tell you, purchasing a life insurance policy still, it's often, I would say, neglected in a financial strategy step because a lot of people feel they don't need it. But let me tell you, if you care about, your loved ones, and if you know that maybe your children are having some difficulties with careers and all that, you know what? A life insurance policy could be a way to lessen some of that stress if something should happen to you for your loved ones. And the last thing
Yeah.
any of us want for our loved ones is to struggle to pay the mortgage that you still have or family expenses while they're still in the grieving process. So
Yeah.
I also consider that if you're, let's say, a stay-at-home parent, wow. A life insurance policy is still a solid option if your spouse or partner's income wouldn't position them to cover, let's say, the household expenses and, people or services they handle the many, many things. So
Yeah.
got to make sure that life insurance can really, really play a difference. In today's times, Tony, life insurance is used in many different factors now, which I truly appreciate what it does and the different strategies that it provides for many retirees.
Yeah. Yeah. And I know it's a great tool. You don't want to leave your loved ones in a bad situation should something happen to you. I think that's huge. You've covered a lot in today's show. We're about out
Mhm.
of time. So just before we go today, let our listeners know one more time how they can get a hold of you and set up that no charge, no obligation consultation if they have questions about their retirement income plan, their financial plans.
Yeah, folks, if you're concerned, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. That is Kaizen, Kaizn. We will answer your questions. We will put a complimentary plan for you, and we will make sure that you're up to date in all those little movements and nuances because that's what really makes a difference in your financial plan.
That it sure does. Well, Albert, thank you so much. Great show today, listeners and viewers. Thanks for tuning in. That does it for today's episode of the Own Your Retirement podcast with our host, Albert Lalonde.
Take care, everybody.